These jobless claim numbers, they are the big story of the day. And so showing 4.4 million Americans filing for those jobless claims last week. And that does bring the total, as I mentioned, to more than 26 million. So for more on this, Chris Markowski joins me now. He's a host of Watchdog on Wall Street radio show and president of Markowski Investments. Chris, it's great to have you with me here. What do you make of these numbers and why are we higher on the news?
I don't want to be the grim reaper here, but I actually think the numbers are worse than they're actually being portrayed. I think many people have had an inability still because of all the shutdowns at various different governments with bad computer systems. Many people have still been unable to file for unemployment. So I think they're actually much worse than they actually are showing.
So a weird trend has been happening in the market, right? One that I think the average investor might scratch their head at, or at least that I'm scratching my head at. And that is that we saw disappointing numbers last week. We saw disappointing numbers this week, and yet the market rises on the news. So is it a case that bad news is good news for investors?
I don't think that that's necessarily the case. They're looking so much at the job. I think it's already baked into the proverbial cake right now. When you say disappointing, I think a lot of people knew this was going to happen already. I think some of the earnings that came out earlier today, Target and Eli Lilly and some of the other ones have been better than expected, that are holding up to some degree. Let's all understand that the Fed has put a basic floor in, a put underneath the market. The Federal Reserve's not involved with all the money that they've put in and backing up a lot of these bonds and buying almost junk bonds to some degree. I think we'd see a market that'd be much, much lower than it is right now.
Okay, so oil stabilizing today, that could obviously be a factor in all of this. It appears that traders are betting and that we might actually get cuts in U.S. production. The U.S. has been a holdout up until now. Do you anticipate that will come, and will that be a boon for stocks?
They have to put the oil somewhere. I've been following the oil markets for decades now, and negative $38 a barrel the other day. It was something you could never even imagine. But there's no place to put it, and no one's buying it. I haven't put gas in my car in over 2 months, and I still have more than 3/4 of a tank left. So supply and demand actually works. And I know traders are moving the various different contracts here, there, and everywhere. But when those contracts are going to expire, you're going to see a fall again. I think there's been people out there predicting to go negative 100 next time around.
Yeah, negative 100 is, I think, the real fear for a lot of people out there. And so the volatility that we see in the oil market, realistically, how long do you think that will last? Because if there already aren't places to store it, I think investors are wondering, is this going to be a 12-month situation where oil prices remain extremely depressed and volatile?
It's all when everybody starts to open up again. Everything is dependent upon that. Businesses starting open up, the country opens up, you start seeing demand increase. It's basic econ 101, supply and demand.
Okay, some of these companies are reporting earnings. Domino's a bright spot this morning. Obviously, its restaurant can survive on takeout and delivery, hiring 10,000 workers. But broadly speaking, if you're not a drug company, if you're not a restaurant that can operate with takeout, if you're not a tech company that handles a social media platform like Facebook or Snap, most of these companies are set to release bad results. What should investors take away from this earnings season? And as the companies report, what are the most important things to be listening for?
What I've been looking for, what I've been telling our clients to do always during recessionary periods, even though this is basically a self-induced recession, is you always have to go to quality. Recessions, they find where the weak parts are in the economy. It's kind of a bad analogy to some degree, but it acts almost like a coronavirus. It goes to someone's weaknesses. And you're seeing retail, you're seeing all of these areas that were weak before we went into this, and they're really getting beat up right now. So you have to go to strength, and you have to take a look at your portfolio and say to yourself, do I think this company is going to be a strong company on the other side of this? And that's what you have to gravitate to.
Chris, in this market, are you buying, selling, or holding?
I'm a dollar cost average guy. As long as I own quality, I am constantly putting money away on a regular basis, same time, every single month for all of our clients. It doesn't matter. You do that over time, you'll be successful.
All right. Chris Markowski is the host of the Watchdog on Wall Street radio show and president of Markowski Investments. Chris, thanks so much.